Now we'll look at selling bonds at a premium using the straight line amortization method. It's very similar to the discount, only instead of selling it for less, we sold it for more than face value. So to review, contract to market. If it's equal, it sells at par. If it's greater than market, it will sell for a premium. And if it's less, it will sell for a discount. But why? What's going to drive the price up or down? Well, you have to think of demand for your product on the stock market. The contract rate, remember, that's written in the indenture. It's the interest you pay. But the market, that's based on stock market demand. Now, there's a little confusing there because with stocks, it truly is stock market demand, what the investors are willing to pay. But with bonds, it's different. We say it's stock market demand, but it really all has to do with the present value of future cash flows. So think principal and interest. These are future amounts. What's it worth today? Principal is a one-time payment. Interest is a recurring payment, that annuity. So again, think stock market demand. What price is the market demanding? But in reality, it really all has to do with interest rates. Now, the two are tied because stock market demand certainly can influence the Fed to raise or lower interest rates. But pricing, actual pricing, is the present value of future cash flows based on the current market rate of interest and the interest that is your stated or contract rate. So looking at an example, 100,000 10-year bond at 8. What is N? It's 20 because it's compounded twice a year. And market rate is cut in half because, again, it compounds twice a year. 3% in 6 months plus 3% in the next 6 months equals the annual market rate of 6%. So using present value tables, present value of 1 for the principal because it's a one-time payment. Present value of annuity, that ordinary annuity, of 4,000 times the table value gives you a selling price greater than the face value because your bond is paying 8% interest, other bonds on the market are only paying 6%. It increases the price of your bond, demanding a premium price. But same with discounts, you have to get rid of that through amortization. And remember, when you're trying to think, what do I use for N, what do I use for I? Contract determines N, market determines I. This is your initial journal entry. Instead of a contra liability, this is called an adjunct liability because it adds to the value instead of subtracting from the value, increasing the carrying value. Premium on bonds payable is an adjunct, so the carrying value on the sale is $114,878. It has to equal $100,000 at maturity, and that's done through amortization. Most accounting principles courses teach just the straight line method or introduce that into principles. Intermediate studies the effective interest method with a comparison to the straight line. The effective interest method is actually the preferred GAAP method, although it is allowed to use a straight line for the cost effectiveness constraint. So looking at straight line, life of the bond 10 years, compounded semi-annually. I take the entire premium divided by how many compound periods? 20 to get 744. This is your initial journal entry for recording the first interest expense. Now notice that the cash is more than interest expense, just opposite of how discounts were. But that's okay, you got more money up front. Notice the journal entry is identical every 6 months. The premium amortization does not change. That's the simple straight line method, so that at maturity, the bond's carrying value equals the face value Bond carrying value initially was $114,878. A couple years later, after 4 periods of amortization, bond carrying value is steadily decreasing until maturity when premium on bonds payable is fully amortized. Remember that premium on bonds payable is an adjunct liability because it increases the carrying value. Now looking at a comparison, when contract equals market, it will sell at par. And running the numbers, running the present value of the future cash flows, it proves that's correct. The bond's present value is $100,000, base value. But if your contract is higher That means you're paying more interest, cash interest to investors than other bonds, which increases the selling price. Contract equals market, it sells at par, but you're paying more cash interest, that drives up the price, so you can think stock market demand, but in reality, it all has to do with the present value of future cash flows.